Hi, Joe LaPresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, December 29th. Well, this is obviously our year-end wrap-up, and in this update, I want to kind of break it into two pieces. One, we're going to look at the current action in our core and proprietary indicators. Just going to save that for the second half of this week's update. I want to start out by looking at a little bit longer term view of the stock market and where we find ourselves today, where stocks last year 2022 had a big drop. This year they've had a recovery. We're essentially at the same level we were 2 years ago. S&P 500 is coming close, knocking on the door of a new all-time high. Hasn't quite got there yet, but it's trading basically where it was beginning 2022. Now, they say the stock market and history doesn't repeat itself, but it often rhymes. In other words, no one period is exactly like a period previously, but is similar to a period in previous history. Now, we find a lot of value in looking at market history and assimilating it to today's situation and trying to identify how is today's market similar to other markets in the past. And let me give you one example as we go into our past dashboard. And almost every week we look at our overbought, oversold indicator. And this indicator, as much of our market model was built on market history. A great example is looking at this channel. It's built on how the stock market has traded during other bull market periods and how we expect it to trade during this bull market period. And when we look at it hitting the high in July and almost immediately starting to drop to the low in October, this was a textbook correction. And really, this indicator called it almost perfect. Right? Got to the red line. That's an overbought condition. Stocks are likely to correct. Got to the green line. That's an oversold condition. Stocks are likely to rebound as long as we stayed in a bull market. So when we look at market history, we like to assimilate current situation to the past to try to get a handle and give us an edge on how the future might play out. Now, that's a tricky game, but at least it gives us some information and a knowledge base to work off of compared to guesswork. And we like to do that same type of assimilation, not just on a short-term basis like with our overbought, oversold indicator, but on a longer-term basis as well. So that leads us to looking at this chart, a very long-term look at the S&P 500. And our model is essentially based off of this thesis. When we look at equity market decline and recovery periods, and looking at it over a very long period, so starting in 1950 through current, we're looking at 74 years of stock market history, and then breaking down the S&P 500 movement, which of course has been higher during that time, but then breaking it down to periods when investors that are in the market are building new wealth, and those are the green segments of the chart, and that's when the stock market's at a new all-time high. And investors that own stocks are, building new wealth because their portfolio values are likely at new all-time highs as well if they're invested in the S&P. And then looking at the periods when investors are losing wealth, and those are the red segments on the chart. And those are defined as bear markets, declines of 20% or more. And then looking at recoveries from the losses. In other words, when the market went through a 20% or more decline, that it was recovering, but not at a new high. And what we find over the 74 years is that the stock market is either declining or recovering from a decline 55% of the time, more than half of the time. And investors that stay in the market through the full 74 years are only building new wealth 45% of the time. So that leads us to believe, and why it was our initiative to develop models that say, well, why would we want to just be invested in the market all the time when really buy and hold investors are only building new wealth less than half of the time. Now, this chart is not adjusted for dividends, so dividends would increase investment performance over the years, but it's also not adjusted for inflation and the inflationary impact on portfolio values. Now we look at the current situation and try to assimilate it to a previous time in market history. So we could see, last year there was a 20% or more drop, as noted by the red period on the chart. We hit the bottom, and then we started the blue period, the recovery from a loss. And you could see that we're knocking on the door of hitting a new high and moving into a green phase of building new wealth in the market, but we haven't quite hit that yet. Maybe it will as we move into 2024. And we say, okay, well, that's about a 2-year period where stocks haven't made any progress, so that adds to the declining and recovering from a decline period. In fact, that percentage went up as we updated this chart to show you the presentation today. So when have there been other 2-year periods when the market hasn't hit a new high? They're pretty rare. We've gone 500 or so trading days without the market hitting a new high. Doesn't happen all that often. But we could look back to, say, this period, when the market went through much more than 2 years. In fact, it went through about 13 years where stocks didn't hit new highs. There was a much bigger drop to start off that bear market, and then a big recovery, which came right up to the high, only for another decline, major one, to happen. That was the big 2008 decline. And the recovery, it wasn't until 2013 from the year 2000 that really investors that held through this whole period started to make new progress. We can't really say this is a period like that because we didn't get as big of a decline to start off the bear market. We got the recovery much quicker. So for now, we would rule out the current market period being something similar to 2000. We go back to, say, 1987. Well, this is kind of interesting because that was just about a 2-year period where the market dropped. We had the crash in 1987 and the recovery. It took about 2 years. I'm going to fast forward it or reverse it back way to 1961, 62, 63. Very similar, of a 20% or more drop, and then a long period for it to recover, about 2 years. Let's take a closer look at each of these two periods. So here's the 1987 period. We could see very fast drop. The drop itself only happened in a few months. And then it started to recover, and it wasn't until July, August of 1989, about 2 years later, market hit a new high, and it made some progress from there. It did stall out for several months after hitting that new high, but eventually it made some progress, and as we go back and look at that bigger chart, which is right in this period, made significant progress. It boomed as we got into the 90s. Right, so are we going to see a similar situation? Was the drop and recovery, are we at this crossroads now where the market might hesitate a little bit and then surge for many more years? It's possible. We don't think that's likely. And the reason is, flipping over to our AWM valuation indicator, this is what John covered in our last update. 1987, stock market valuation was dirt cheap. One of the lowest in this long history, 60-year history of this valuation indicator. We were down here. Good time to buy stocks for the long term. And look what happened through the 1990s. Stocks went from dirt cheap to extremely expensive. And then the big 10-year bear market of the 2000s started. So now we're up here. Now, we're not at all-time highs, as John pointed out last time, but we're pretty high from a valuation perspective. So we wouldn't expect this bear market of 2022 and recovery in 2023 to lead to a 10-year boom moving forward. And then there's the early 1960s. Now, we're obviously going back quite some time in history here, before my time, and seeing 20% or more drop, Recovery started in, looks like late 1961 to me, and the recovery occurred maybe late 1963. It's about a 2-year period. But then the market did make some pretty good progress, right? And even did so in the face of assassination of our president, right? So, oftentimes, one of the concerns that I hear from clients is geopolitical concerns and political concerns, and those generally don't matter to the stock market except for very short-term periods. And I want you to keep that in mind as we go into 2024, because obviously it's an election year and we could expect just a lot of noise around the business world, and most of it political in nature. Generally doesn't influence stock prices. So is the current period like this, where we're at this point and we're just about to hit a new high and we just follow through and proceed and go up? As you could see in 1964, 1965, go up for a couple of years before the next bear market occurs. It's possible. But there's another period that I want to take a look at as well, because it's also possible that the current period is similar to this one, and that's looking at, say, the late 1960s through the early 1980s. And what was so different about that was it wasn't a one-off, 20% drop, recovery, onto new highs. There were multiple 20% drops, followed by a recovery and the next 20% drop, and that repeated for well over a decade. So let's take a enlarged view of that period as we go from, say, the mid-60s to the mid-80s, that 20-year period. And what I really want to focus in on are these cycles in the market, right? So we got the first 20% drop, as you can see here, say 1966. The recovery, we just barely hit new highs, as you can see some green on the chart, meaning that the S&P hit a new all-time high for a few months before the next bear market hit. And then it took more time to recover. And then we hit another new all-time high for just a short time before the next and biggest bear market of this period hit. 1973, 1974 was a big drop in the stock market. Took a longer time to recover and hit a new all-time high in 1980 or 81, just before the next 20% or more decline hit. And then the recovery before finally stocks started to take off in 1982, 83, 84. So we have to be aware that today's situation could be similar to something like this, and what makes it a little more alarming is that was the last high inflationary period we had. And we all know that inflation has been higher in the last couple of years than we've had in many years. And the Fed has even said that today's economy, is similar to the 1970s, and they're concerned about it, which is why they raised interest rates so much. So we don't know what this period is similar to, but we have some guides to work off of. And what we find more comforting than that is having our model to help guide us. Our model gave us that global sell signal last year to help avoid the bear part of this 2-year period. It gave us a global buy signal a little over a year ago to help us identify the bull cycle beginning. Asset class selection was a little off at the beginning, but has come on with our latest signal, the confirmed up signal last month, and the new asset class selection seems to be much more spot on. Now, we didn't have our model going back to the 1980s and the 1970s and 60s and those other periods we looked at. But, we feel confident that if we did, the model would have picked up those 20% or more declines with sell signals and would have picked up the recovery periods, just like it did last year with the sell signal and late last year into early this year with the buy signal. So we'll continue to use our model as the guide. And right now, everything's firing to the upside. We have all green arrows. We have, all green arrows with our core indicators. Even the universe trend indicator since our last update has moved from neutral to positive, so that's an encouraging development. In fact, let's take a look at a couple of these in the latest progress that they've made. So here's the universe trend indicators, and the traditional one had reversed up early this month and has really followed through. We're now at about 52, getting close to 53%. So that's some nice improvement. And the logarithmic version also has reversed up. So 6% move is required. We finally got that 6% move from 50. We're now at 56.7. So that's good to see. Now, one of the things we pointed out early in this buy signal that confirmed up just a month or so ago, maybe 6 weeks, is that we wanted to see breadth develop. We wanted to see breadth start to expand. We've seen that, particularly as we got into December. But you just wonder if a lot of that is year-end positioning. A lot of the small companies which were really beaten down have performed very well, and they've gone up. Small cap stocks have done very well. We'll see if that's some follow-through as we get into early 2024, or if it's just seasonality adjustments. But nonetheless, definitely seeing better short to near intermediate term action here, and that's optimistic. What we'd like to see now is the highs that we hit in the middle part of this year before the correction. We'd like to see those surpassed, and we're not there yet, right, in either of the charts. And even more important, if we go back to the previous highs on this chart was in April of 2020, way up here at 64%. We're quite a bit below that now. And on this chart, not even close. It was at 78%. We're 20% or more below. So stock market's approaching a new high. These charts are nowhere near. So from a long-term perspective, they're not leading the charge, right? Better in recent action, but definitely not leading the charge, and something to watch as we go into 2024. And as we move on to our cash comparison charts, similar type of conclusion where recent action pretty good. In fact, the cash comparison rate of change chart did surpass its July high, so that's good progress. The relative strength chart has not, but getting close, but neither one are near their all-time highs. So this is a good look at the inflation-adjusted impact on the MSCI All Country World Index, where getting close to a new high, but when you adjust it for inflation, it's not close to a new high. So you might see that erosion effect, beginning to take place. Now, we don't know how inflation is going to play out. Nobody does. We're going to talk about that in a minute, in fact, and look at money supply and just how extreme the movements have been in the last couple of years. And what we really conclude is just an experiment. Right? We've never seen anything like this before in terms of the expansion of money supply followed by the major contraction we're seeing now of money supply. But this is positive trend analysis and progression. Just long term, some concerns remain. But you can't argue with all green arrows. With these core indicators, the long-term momentum indicator, we're going to get our update after today's close, end of December, and that's going to be positive as well, of course, with the markets basically sitting at their high. So all three core indicators are positive. The model is positive. Right now, we expect to see carry through into early 2024, but we're not really interested or looking to make long-term projections into 2024 because our economic model is still negative, our market valuation model is still high. We don't think we're starting a very long-term bull cycle, but one of those opportunistic cycles in what might be within the context of a longer-term period in which stocks don't make a lot of progress. From a tactical perspective, we're definitely getting to higher risk levels. Let's take a look at our 10-week chart as an example. As you can see, is at 76%. So you can see we are now above the high risk level. And I don't want to caution too much here because there's two ways to look at this. One is we are at a high risk level. Sometimes high risk readings early in a new PAS model buy signal is actually a sign of strength that indicates strong buying pressures coming into the market. And it could carry through for a while. And we'd have to say this is still very early in a new bull cycle. We're only a month and a half or so into it. But at the same time, it's probably not a good time to add new capital into the market unless there's a pullback. But high levels are not necessarily a time to sell what we own, right? So I wouldn't throw too much caution into this high level. It's just that, we're not down here anymore when stocks were at much better buy positions than they are after a big run in the market. Well, as I said just a minute ago, we really think that what's happening with policy, economic policy from the Federal Reserve, obviously policy from the federal government, everything's really an experiment at this point. We've seen the Fed make a lot of projections and forecasts that haven't proved to be accurate in recent years. The latest market move is largely based on the fact that just 2 weeks ago, the Fed had their latest meeting and the chairman, Jerome Powell, said, we're probably done raising interest rates. In fact, next year, we might be cutting interest rates. Well, they haven't made a good long-term projection in a long time, right? They went way too far in pumping money into the economy after COVID. I think they did a good job of handling the pandemic shutdown of the economy and stabilizing things pretty quick. But they just kept money in and policy loose for way too long. They said the inflation was going to be transitory. It turned out to be much more enrooted into the economy than transitory. Once they finally came around to determining they were wrong in that forecast, they started raising rates. They've raised rates aggressively, one of the fastest increases of interest rates because they were behind the curve. They brought rates from 0 to 5.25%, 5.5% in a very short time. Every time they've raised rates like that before, there's been major economic fallout. We haven't had that yet, but maybe that's still ahead in 2024. Our economic model is still recession warning territory. We'll get our November update next week and let you know if there anything major changes there. So now that they're saying, well, we're probably done and inflation's coming down, is that going to be spot on? Is it going to be right? The market's priced for that. Market's priced for almost a perfect scenario right now. They think inflation's going to stay down. If inflation starts to ramp up again for any number of reasons, the market's not priced for that. And what else it's not priced for is if the landing isn't soft, but it's hard. We have a recession and maybe deflation. We're not seeing great things in other big economies around the world. China, for example. A lot of the European economies struggling. We're on the brink of a global recession if you look at global economic activity. The U.S. is kind of an island of strength. How long could we stay an island of strength if everything around us is deteriorating? When I say it's all a big experiment, we don't have to look any farther than the M2 money supply. Throughout history, money supply has increased. Sometimes it's leveled off, sometimes it's grown faster than at other times, but it's never shrunk. At least going back to the 1960s, as far back as this chart goes. Maybe during the Depression era, I don't know. It might have shrunk. This chart doesn't go that far back. During the big recession in 2008, it didn't shrink then either. In fact, it expanded quite a bit as the Fed tried to get us out of recession. Well, now we're shrinking, and we have been for a fair amount of time at this point. When we look at M2 money supply, which is the broad measure of money supply, on a year-over-year basis, I think it really paints that picture even more. Up until recently, we've never had year-over-year decline in M2 money supply, not going back to the 1960s. So, we have negative money supply growth now. Right now, we're 2.95% less money supply than there was a year ago. That year-over-year growth went negative this time last year in December of 2022. So this is an experiment. This has never happened before. We don't know how it's going to play out. Of course, that follows the biggest expansion of money supply ever. And when they expanded it the most they ever have, they thought they could do it without it causing sticky inflation. They weren't able to. Inflation stuck around much longer and much higher than they wanted to, so they had to shrink the money supply to try to get that under control. And Now the narrative is that, well, there's going to be a soft landing and we're not going to have a recession and we're going to be able to bring inflation down to 2%. Everything's going to be fine. Can they really do that? Can they cause the first ever negative growth of money supply ever without economic fallout, without a recession or some other unintended consequence that they can't anticipate at this point? We had a little mini banking crisis earlier this year that was part of the unintended consequences, but there could be others. Keep in mind, our recession models are still poking their head lower and warning of a recession. We'll get our update next week for the end of November, and we'll let you know if anything major changes. But this is a big experiment, and I don't think anybody knows how it's going to play out at this point. The market seems to think they have it figured out and have a big surge in stock prices based off of kind of a perfect scenario. Anything less than perfection could cause some volatility, probably later in 2024 than earlier, but we'll see how that plays out. So in summary, right now, market cycle looks fine. Our indicators are all firing. Things look good. Technical indicators are getting a little high, but that's not a concern early in a new signal with our model, historically speaking. On a longer term perspective, when we look at 2-year periods, similar to what we've had in 22 and 23, is this going to be like 1987 or 1962, in which there was kind of a one-off bear market, a recovery, and once we hit new highs, it followed through before the next major bear market happened 2, 3, 4 years. And in the case of 1987, it wasn't really until 2000, many years later. It's possible. Or is it going to be something like the late 60s and 70s, where we had the bear market and a recovery and a little bit more progress before the next bear market hit, and another recovery, and a little bit more progress before yet another bear market, and that happened repeatedly? We don't know what it's going to be like, but we'll use our model to help identify those cycles, certainly help with last year's bear market, help with this year's bull market. We think it'll help when we get the next change of market cycle from a bull to whenever that bear market is. If it's earlier or if it's later, we'll fall on our market cycle indicators to help make those determinations. Well, I want to thank you for watching our updates throughout the year. I want to thank you for watching this one. I want to wish you a very happy, healthy, and peaceful 2024. We'll be back with our next update in 2 weeks. Enjoy.